I've been reflecting deeply on something Greg Abel discussed recently that really captures the magnitude of the transformation we're witnessing. He described a massive power plant in Iowa, not servicing a town, not powering a city, but dedicated entirely to running one of Google's data centers. Think about that for a moment. A single server farm requiring the electrical output of what would have powered entire communities just a generation ago. When you multiply this across the globe, Google, Amazon, Microsoft, and countless others building these enormous computing facilities on every continent, you begin to grasp that we're not just witnessing incremental change. We're watching the architecture of the modern world being rebuilt from the ground up, and it's happening at a velocity that's almost difficult to comprehend. This kind of transformation, as extraordinary as it is, comes with profound consequences. It will hurt people, many people, just as every previous wave of technological disruption has left casualties in its wake. The cotton gin, the assembly line, the personal computer, the internet. Each advancement created tremendous value while simultaneously destroying livelihoods and rendering entire skill sets obsolete. We're in the midst of another such moment, perhaps the most dramatic yet, and the displacement will be real and painful for those on the wrong side of the transition. Now, when I look at Berkshire's portfolio through this lens, I believe we're generally in pretty good shape. We've positioned ourselves, sometimes through deliberate strategy and sometimes through fortunate circumstance, in businesses that have durable moats around them. But that doesn't mean we're invulnerable. Every company, no matter how well positioned, has weak points. Where exactly are we most vulnerable? Well, I'd prefer not to name specific businesses or sectors within our portfolio. Once I start pointing fingers at particular holdings, everyone will start dissecting those operations. Analysts will pounce on any perceived weakness, and it creates unnecessary turmoil. Let's just say I'm aware of where the pressure points are, and we're monitoring them closely. What I will discuss openly is retailing, because this vulnerability extends far beyond Berkshire. It's an industry-wide challenge that's impossible to ignore. Retail is facing truly significant, existential threats. The shift to e-commerce, the changing consumer behaviors, the logistics advantages that large online platforms possess, the data they're accumulating about purchasing patterns. It's creating a perfect storm for traditional retail operations. When I started in business, the local department store or Main Street retailer had natural advantages. Proximity, the ability to see and touch products, immediate gratification, personal service. Many of those advantages have eroded or been neutralized entirely. A teenager in a small town today has access to a wider selection of products on their phone than the largest department store could have stocked 50 years ago, often at better prices, delivered to their door within days or even hours. When any business or industry finds itself threatened in this way, the natural response is to fight back. And I don't mean that pejoratively. It's human nature, it's survival instinct, it's what you'd expect rational actors to do. But how businesses fight back, and whether those defensive measures actually work, varies dramatically. Sometimes the fight involves genuine innovation and adaptation. More often, unfortunately, it involves trying to erect barriers to protect the old way of doing things. Let me illustrate this with a story from insurance history, because it's a perfect parallel and one I know intimately. Go back to around 1921, when State Farm was founded. Before State Farm arrived on the scene, the agency system had been the unchallenged model for selling insurance since the industry's inception. The big, prestigious insurance companies, and I mean the real heavyweights of American business, were concentrated in Hartford and New York. These were institutions that had been around forever, household names that represented stability and tradition. Their entire business model revolved around the agency system. If you were Travelers or Aetna or Hartford or any of the other major carriers, and you wanted to expand into a new market like Omaha, your strategy was straightforward. You identified the most respected, best-connected insurance agent in town and you signed them up. That agent became your representative, your storefront, your sales force. The actual policyholders, the people buying the insurance, were almost an afterthought in this equation. The competition wasn't really about who could offer the best policy or the best price to consumers. The competition was about who could lock up the best agents. You'd wine them and dine them, offer them higher commissions, give them better support, anything to keep them loyal to your company rather than your competitors. The agents held tremendous power in this system. They were the gatekeepers between the insurance companies and the public. Companies paid handsomely for their loyalty, and the agents knew it. The whole structure was built on personal relationships between company representatives and local agents, with the cost of this entire apparatus naturally being passed along to policyholders in the form of higher premiums. Then State Farm came along with what seemed like a radical idea at the time. What if you eliminated the independent agent entirely? What if you hired your own employees, paid them salaries instead of commissions, and passed the savings directly to policyholders? They had a better mousetrap, lower costs, more direct relationships with customers, better alignment of incentives. And they started growing rapidly, particularly among middle-class Americans who were price-conscious and didn't see much value in having a local agent who might help them file a claim once every decade. The established insurance companies were horrified. This wasn't just competition. This was an attack on the fundamental structure of their industry. They had billions of dollars invested in relationships with agents, in marketing through agency networks, in training programs for agents, in the entire infrastructure of the agency system. State Farm's model threatened to render all of that obsolete. So they fought back, and they fought hard. But here's where it gets interesting from a business strategy perspective. They didn't primarily fight back by improving their own efficiency or lowering their prices or innovating in ways that would benefit consumers. Instead, they went to state legislatures and insurance commissioners, and they lobbied intensely for regulations that would hamstring companies like State Farm. They pushed for laws requiring certain types of insurance to be sold only through licensed independent agents. They argued for regulations about what direct writing insurance companies could and couldn't do. They tried to use the power of the state to protect their business model from competition. And you know what? They had some success initially. They managed to get various restrictions passed in different states. They created regulatory hurdles that slowed State Farm's expansion. But it was ultimately a delaying action, not a solution. Because consumers realized they were paying less for equivalent or better coverage, and that reality was impossible to suppress indefinitely. Then, decades later, Geico came along with an even better mousetrap, direct sales through the mail and telephone, and eventually the internet, cutting costs even further. And the cycle repeated itself. The established companies, including by then State Farm, pushed back against this new model. They lobbied regulators. They ran advertising campaigns questioning whether you could trust an insurance company you'd never met face-to-face. They emphasized the value of having a local agent or representative. But again, the economics were so compelling for consumers that the superior model gradually won out. This pattern is standard across virtually every industry that faces disruption. The incumbents fight to preserve their position, often by erecting regulatory or legal barriers rather than by genuine innovation. Sometimes they succeed in delaying the transition for years or even decades. But eventually, almost always, the better mousetrap wins. The more efficient model prevails. The business that delivers more value to customers at lower cost captures market share, and the old guard either adapts or slowly fades into irrelevance. Now, you mentioned some specific companies earlier. I assume technology or retail companies, though I didn't catch the exact names. I don't know anything substantive about their specific prospects. I know what they do in a general sense. I see their stores or use their services like anyone else, but I don't have the detailed knowledge to predict whether they'll be winners or losers in their particular competitive landscapes. And this is precisely why we tend to stay away from those sectors when it comes to major investments. We know there will be enormous change in technology, in retail, in media, in telecommunications. We know these industries are being revolutionized. What we don't know is who exactly will emerge as the dominant players. Will it be the current leaders who successfully adapt? Will it be nimble startups that displace them? Will it be some hybrid model we haven't even imagined yet? These are extraordinarily difficult questions, and anyone who claims to know the answers with certainty is either fooling themselves or trying to fool you. So we've made a conscious choice to stick with businesses where we can identify the winners with confidence. Our railroad, BNSF. Is anyone going to invent a better way to move bulk goods across the continent? Could there be innovations in rail technology? Certainly. Could regulations change? Of course. But the fundamental economic logic of rail transportation for heavy freight isn't going anywhere. Our energy utilities. People need electricity, they need natural gas, and the infrastructure to deliver those services is so capital-intensive and so regulated that you're not going to see 7 competitors suddenly spring up in the same territory. Our insurance operations. People need insurance, businesses need insurance, and we've built such enormous scale and such deep underwriting expertise that we have sustainable competitive advantages. Are these businesses completely immune to change? Of course not. Nothing is. They face regulatory challenges, technological shifts, competitive pressures, changing consumer preferences. But we can look at these businesses and say with high confidence, in 10 years, in 20 years, They will still be substantial, profitable operations serving essential needs. We know they're going to be winners, even if the precise nature of their operations evolves. Contrast that with trying to pick the winning smartphone manufacturer, or the dominant social media platform, or the leading e-commerce player in a particular category. These are fascinating businesses, often with brilliant management teams and revolutionary products. But the competitive dynamics are so fluid, the technology changes so rapidly, the consumer preferences shift so unpredictably, that making long-term predictions becomes more speculation than analysis. We find these industries intellectually interesting. I read about them, Charlie and I discuss them. We watch with fascination as they evolve. But we don't let that fascination tempt us into making large investments where our edge is minimal or non-existent. Now, on a more personal note, I'm genuinely delighted to hear that your son Warren, now 7 years old, is doing great. Please give him my regards, and tell him I appreciate his Buffalo reference, even if it makes you cringe a bit. These things have a way of taking on a life of their own. I've been called worse things than a buffalo, believe me, so I can take it. Your question about Berkshire's future market capitalization is one I've been wrestling with quite a bit lately, and it gets to the heart of a challenge I plan to address in considerable detail in next year's annual letter. You've outlined a scenario where Berkshire doubles in value over the next 10 years, then doubles again, reaching a market cap of $1.2 trillion. You even added with a laugh whether we could get there sooner. Here's the reality: the mathematical progression you've described may not hold up, and it's not because we'll fail, but because we'll succeed too much. That probably sounds paradoxical, so let me explain. Berkshire today generates enormous amounts of cash, from our insurance operations, from our railroad, from our utilities, from our manufacturing businesses, from our investments. We're talking about tens of billions of dollars in annual free cash flow. And that number keeps growing. For decades, my job, one of my primary responsibilities as CEO, has been to find intelligent places to deploy that capital. We've bought businesses, made acquisitions, invested in securities, built out our existing operations. And we've been reasonably successful at this. But here's the inescapable mathematical reality. As we get larger, the universe of opportunities that can meaningfully move the needle for Berkshire shrinks. When Berkshire's market cap was $10 billion, a $500 million acquisition was significant. It could add 5% to our value if it worked out well. When we're a $1 trillion company, that same $500 million acquisition is a rounding error. It's 0.05% of our value. To have the same proportional impact, we'd need to make a $50 billion acquisition, and there simply aren't that many $50 billion opportunities that meet our criteria: good businesses, understandable economics, honest and competent management, sensible prices. So there will come a point, and I don't think it's in the distant future, though I hope it's not immediately upon us, where we will have more cash flowing in than we can intelligently deploy in business operations. This isn't a tragedy or a failure. As Charlie would say, it's not a tragedy to succeed so much that future returns moderate. That's just what success looks like. That's winning. But it does create a different set of challenges and decisions. When we reach that point, the critical question becomes, what do we do with the excess cash? There are really only a few options. We could pay it out as dividends, returning capital to shareholders and letting them make their own investment decisions. Personally, I've never been a fan of this approach for Berkshire. Dividends are tax inefficient. Shareholders pay taxes on the distribution, then have to find somewhere else to invest what's left. And frankly, I'd like to think that I can deploy capital more effectively than the average shareholder, though I recognize that's a somewhat presumptuous position. We could make acquisitions that don't quite meet our usual standards, slightly lower returns, somewhat shakier businesses, prices that are a bit rich. This would allow us to keep growing, keep deploying capital, keep the machine running. But this is how great companies become mediocre companies. This is how you erode value over time. I've watched too many CEOs, too many boards, justify increasingly dubious acquisitions simply because they couldn't resist the urge to do something with their cash. I'd like to think we'd have the discipline to avoid that trap. Or we could repurchase our own shares. And this is where circumstances at the time become absolutely critical. If Berkshire stock is trading at a price significantly below its intrinsic value, meaning continuing shareholders would see their ownership percentage increase more than proportionally to the cash spent, then buybacks are an excellent use of capital. Every dollar spent repurchasing undervalued shares increases the value of the shares that remain. It's accretive in the truest sense. But if our stock is trading at a premium to intrinsic value, or even at a fair price, then buybacks become questionable. You're spending $1.10 or $1.20 to buy something worth $1. That doesn't make sense, and it's certainly not in the interest of continuing shareholders, even if it temporarily boosts per-share metrics through financial engineering. So my answer to what we'll do with excess cash is genuinely, it depends on circumstances at that time. What will the business environment look like? Will we be in a period of economic expansion with lots of capital competing for deals, or will we be in a downturn with assets available at distressed prices? What will tax laws be? Right now, corporate tax rates are at certain levels, capital gains taxes are at certain levels, but these change with every administration, every Congress. What will our stock price be relative to intrinsic value? This fluctuates constantly based on market sentiment, interest rates, economic conditions. What I can tell you with absolute certainty is this: whatever decision we make will be made with one question in mind. Is this in the best interest of continuing shareholders? Not management's interest, not Wall Street's interest, not even necessarily the interest of shareholders who might want to sell tomorrow. The interest of the shareholder who wants to stay with Berkshire for the long term. Every major capital allocation decision starts from that principle and works forward from there. If I were still around when this point arrives, and who knows, given actuarial tables and my lifestyle, whether I will be, and if circumstances were right, meaning our stock was trading at a meaningful discount to intrinsic value, I would probably be very aggressive about repurchasing shares. I mean really aggressive. We could be talking about buying back $30 billion, $50 billion, $100 billion worth of stock if the price were right. Because I know Berkshire's businesses intimately, I understand their earning power, I can calculate intrinsic value with reasonable precision, and if Mr. Market is offering me the chance to buy into that value at a substantial discount, I'm going to take him up on it enthusiastically. But all of that is speculative, because the circumstances could be completely different. We might find ourselves in a period where the stock is richly valued and buybacks make no sense. We might encounter acquisition opportunities we can't foresee today. Tax laws might change in ways that alter the calculus entirely. The point is, we'll have the problem, excess cash beyond what we can intelligently deploy, and we'll address it based on the situation we're actually in, not based on some predetermined formula or plan. Now, let me address a completely different set of questions that came up about education and healthcare, particularly comparing prospects between the United States and Asia. These are genuinely difficult topics, especially this late in the day when our minds are perhaps not at their sharpest. But they're important enough that I want to give you my honest perspective. I think America made a huge, tragic mistake when we allowed our public school system to deteriorate the way it has. And I don't mean this as a partisan political statement. This cuts across administrations and ideologies and decades of policy decisions. When I was growing up, American public schools were among the best in the world. They were engines of social mobility, places where a kid from any background could get a solid education, learn to read and write and do mathematics and think critically. They produced the scientists and engineers and business people and citizens who made America the most dynamic economy on earth. Somewhere along the line, we lost our commitment to maintaining that excellence. We've underinvested in teacher salaries, making it difficult to attract top talent into the profession. We've loaded teachers down with administrative burdens and testing requirements that consume time better spent actually teaching. We've allowed school buildings to fall into disrepair. We've created enormous disparities between wealthy districts and poor districts, effectively creating separate and unequal systems based on zip code. We've politicized curriculum to the point where teachers are sometimes afraid to teach certain topics. We've dealt with behavioral issues and discipline problems in ways that often help neither the disruptive student nor the other students trying to learn. The results are evident in international testing comparisons. American students, particularly in mathematics and science, lag behind peers in many Asian countries and even behind students in some developing nations. And the tragedy is that this isn't about native intelligence or potential. American kids are just as smart as kids anywhere else. It's about the system we've built, or failed to build, around them. Asian cultures, and I'm painting with a broad brush here, recognizing enormous diversity across countries like Japan, South Korea, Singapore, China, and others, have generally maintained a stronger commitment to educational excellence. Teaching is often a more respected and better compensated profession. Parents place enormous emphasis on education and are more involved in supporting their children's learning. Students spend more time studying and face more rigorous academic expectations. The cultures place high value on educational achievement in ways that American culture increasingly doesn't. Now, there are trade-offs to these different approaches. Some Asian educational systems are criticized for being too rigid, too focused on rote memorization, too hard on students' mental health. There's something to those criticisms. But I'd argue they're dealing with the problems of success, too much rigor, too much expectation, while we're dealing with the problems of failure, insufficient rigor, insufficient expectations. I know which set of problems I'd rather have. To the extent that Asian nations are avoiding the mistakes we've made in education, to the extent they're maintaining a cultural commitment to learning and teaching excellence, I genuinely wish we were more like them. Because in a knowledge economy, in a world where technological sophistication matters more than ever, education isn't just a nice-to-have social program. It's fundamental economic infrastructure. Countries that maintain strong educational systems will produce the workforce that drives innovation and growth. Countries that let their educational systems decay will find themselves at an increasing competitive disadvantage. Now, before we wrap up, I want to share a story that relates to some of the difficulties Charlie's been having hearing questions this afternoon. I probably shouldn't tell this because it makes me look foolish, but it's too good not to share, and it perfectly illustrates something about assumptions and perspective. A while back, I started getting worried about Charlie's hearing. We'd be in meetings, and I'd say something to him, and he wouldn't respond. Or I'd ask him a question, and he'd seem not to hear it. We've been partners for more than 40 years at this point, dear friends for even longer, and I didn't know how to broach the subject. How do you tell someone you've known that long, someone you respect that much, that you think they might be going deaf? It felt incredibly awkward. So I went to my doctor and explained the situation. I said, "Doc, I've got this wonderful partner, this brilliant man I've worked with for decades, but I think maybe his hearing is deteriorating, and I don't want to hurt his feelings or make him feel bad by bringing it up directly. What should I do? How should I handle this?" My doctor thought about it for a moment and said, "Well, here's a simple test you can do. Next time you're with him, stand across the room, maybe 20 or 30 feet away. Talk to him in a normal conversational tone of voice, ask him a question, and see if he responds. If he doesn't hear you from across the room, move a little closer and try again. Keep moving closer until he responds, and that will give you a sense of how significant the hearing loss is. Then come back and we'll figure out next steps." So the next time Charlie and I were together in a room, I positioned myself across the room from him. Must have been 25 or 30 feet. I spoke in my normal voice, clear and distinct, and I said, "Charlie, I think we ought to buy General Motors at 35. Do you agree?" Nothing. Not a word, not a nod, not even a flicker of acknowledgement. He just kept looking at whatever he was reading, completely oblivious to what I'd said. Okay, I thought, this is worse than I feared. So I moved closer, maybe halfway across the room now, 15 feet or so. I spoke a little louder this time. "Charlie, I think we ought to buy General Motors at 35. Do you agree?" Still nothing. No reaction whatsoever. He didn't even look up. Now I'm really concerned. I'm thinking we need to get him to an audiologist immediately. This is serious hearing loss. So I walk right up next to him, lean down close to his ear, and I speak clearly and somewhat loudly. "Charlie, I think we ought to buy General Motors at 35. Do you agree?" And Charlie, without even looking up from what he's doing, says in a slightly exasperated tone, for the third time, "Yes." So the hearing problem wasn't on his end at all. It was on mine. He'd heard me perfectly fine all 3 times. I was the one who hadn't heard his responses. The point of the story, beyond the humor at my expense, is that sometimes our assumptions about where problems lie are completely backwards. I diagnosed Charlie with hearing loss when the real issue was that I couldn't hear his replies from across the room. It's a good reminder to question your assumptions, to consider alternative explanations, to test your hypotheses before drawing conclusions. But also, genuinely, if you've got questions for us, speak up. Speak up loudly. Don't be shy, don't mumble, don't assume we heard you if we didn't respond. We're both getting older, meetings run long, rooms get noisy, and sometimes we just need you to project a bit more. There's no shame in asking someone to repeat themselves or to speak louder. It's far better than everyone sitting here assuming communication happened when it didn't.